Mark Carney's speech was filled with calculated rhetoric, signaling not just his perspective on the economy, but also his alignment with broader political and financial interests. To fully grasp the implications of his words, we must break down the key elements of his speech, the political context surrounding it, and what it could mean for the future. Carney, a former governor of the Bank of England and Bank of Canada, carries a reputation as a technocrat with deep ties to global financial institutions. When he speaks, markets listen and policymakers take note. His recent speech was no exception. It was a strategic message aimed at reinforcing a particular economic narrative. First, let's examine the core themes of his address. Carney focused heavily on economic stability and inflation control, emphasizing the importance of central banks maintaining credibility. His comments on inflation were particularly telling. He suggested that recent spikes in inflation were largely due to external shocks, such as supply chain disruptions and geopolitical conflicts. This, of course, aligns with the broader messaging we've heard from central banks and governments, downplaying the role of their own policies in creating inflationary pressures. However, many critics argue that the aggressive monetary policies enacted during the pandemic, such as quantitative easing and prolonged low interest rates, were major contributors to inflation. By attributing inflation primarily to external factors, Carney indirectly absolves policymakers of responsibility. This is a key part of the establishment narrative, presenting inflation as an external problem rather than a consequence of economic mismanagement. Another significant aspect of his speech was his discussion on fiscal responsibility. He warned against excessive government spending, cautioning that without discipline, deficits could spiral out of control. But here's the contradiction. Carney has, in the past, supported large-scale stimulus measures. His current warning against spending seems to be timed conveniently with changing political winds, suggesting that he's positioning himself within a new economic consensus. We also have to consider the political implications. Carney is often floated as a potential political figure himself, possibly even a future prime minister in Canada. His speech wasn't just about economic policy. It was a carefully crafted message aimed at reinforcing his credibility as a leader in both finance and politics. By presenting himself as a voice of reason in uncertain economic times, he strengthens his position as a key player in future policy discussions. Beyond domestic implications, Carney's speech ties into the broader global economic landscape. He has long been an advocate for stronger international coordination on financial matters, particularly in addressing climate change through economic policy. This aligns with his role in organizations pushing for a shift towards ESG, environmental, social, and governance investing, and sustainable finance. His comments on the need for financial stability should also be viewed through this lens. His vision of stability includes integrating climate-related financial policies, which has been a point of contention among free market advocates. So what does this all mean for everyday citizens? When central bankers and influential financial figures like Carney speak, their words often lay the groundwork for future policy moves. If his warnings about fiscal responsibility are taken seriously, we could see tighter government budgets and potentially higher taxes. If his views on inflation become the prevailing narrative, central banks may continue to downplay the role of their own policies in the current economic situation, leading to further distortions in monetary policy. There is also the question of how businesses and investors interpret Carney's messaging. When figures of his stature speak, financial markets react. If his speech is viewed as a precursor to tighter fiscal and monetary policies, markets could brace for reduced liquidity and increased borrowing costs. On the other hand, his alignment with global financial institutions suggests a continued push towards regulatory frameworks that favor institutional investors over smaller businesses and individuals. This could mean stricter compliance measures, additional costs, and shifting investment trends. His stance on climate-related financial policies also has long-term implications. Businesses and industries that do not align with ESG-focused regulations could find themselves at a disadvantage, while those that comply with sustainability-driven financial models may benefit. This could create a significant divide in the market, further entrenching the influence of large corporations while placing additional burdens on smaller businesses. Furthermore, Carney's speech sends a message about the role of central banks in shaping economic priorities. His emphasis on financial stability as a justification for certain regulatory policies suggests that monetary authorities may continue to play an outsized role in determining economic winners and losers. This raises concerns about the concentration of power within unelected financial institutions, which could lead to policies that benefit elite financial players at the expense of broader economic competition. Another key takeaway is how Carney's rhetoric reflects broader trends in global economic governance. His support for international cooperation on financial regulations suggests that national economic policies will continue to be influenced by cross-border agreements and global financial institutions. This could mean a continued shift towards policies that prioritize economic integration over national economic sovereignty, which remains a contentious issue in many countries. Ultimately, Carney's speech wasn't just an analysis of economic trends. It was a strategic positioning statement. It reinforced the establishment's narrative on inflation, subtly shifted responsibility away from central banks, and positioned Carney himself as a credible figure in both economic and political spheres. Whether or not his vision aligns with reality remains to be seen, but one thing is certain: his words were not chosen at random. They were carefully crafted to influence both policymakers and the public, shaping the economic discourse for months to come. His speech serves as a reminder that in high-stakes financial and political arenas, every word carries weight, and every statement is part of a broader strategy to shape the future direction of economic policy and governance.